Right. So what we're going to do today, we're going to start with a very financial application of prospect theory, namely the disposition effect. This wraps up our discussion in prospect theory, and then you will see an assignment on prospect theory this week. It's probably due it's due at least next week, probably more than that, because it depends on the tutorial time. It will be due after the a tutorial, right? So depending on the tutorial time, it might be a week and a half, right? So after that, we're going to talk about CAPM and the empirical verification of whether CAPM actually works or not. Right. So let's start with some definitions in terms of gains and losses when you invest. So suppose you bought 100 shares of HSBC at $80 per share. Now that's back in 2011. I don't think it's back there yet. It's pretty close. Let's say that's here, right? That black arrow, that's $80. If the price of HSBC is now $90, you are making a profit, right? That's the green arrow. Price has gone up, so you are making a paper profit at least, right? To turn a paper profit to an actual profit, you have to sell your shares. So let's say you sell 60 of your shares, right? Then the percentage of gain realized, PGR, equals to 60 divided by 100. That's 60%. 60%, right? So you have 100 shares. You sell 60 of them. Then PGR is 60%. You can similarly define a similar ratio if you're making a loss. We call that percentage of loss realized, POR, right? So if you're just buying a particular stock once, then clearly that it's quite clear that PGR and POR should add up to 100%, right? You either sell at a gain or sell at a loss. It's highly unlikely you will be able to sell it at the exact same price. So usually you just either sell it at a gain or sell it at a loss. In fact, if you think about it, even if if you're purchasing multiple times, the calculation becomes more complicated, right? Because if you're purchasing multiple times, then the price you purchase would vary over time, right? Let's say you purchase 100 shares at $80 and another 100 shares at $85, right? Then when you sell at $82, are you selling at a gain or selling at a loss? So there are multiple ways you can try to account for that. Some use averages, right? If you buy 100 shares at 80, 100 shares at 85, then the average is 82.5. In that case, selling at 82 will be making a loss. In some other cases, you might want to use first in, first out. So you would consider you're selling the shares you purchased first. So there are multiple ways you can approach that problem. But for our purpose, we would just remember this is the PGR is the percentage of shares that you're selling at a profit, and POR is the percentage of stocks you're selling at a loss. And here is a diagram of the ratio of these two ratios, right? So as you see in the vertical axis, we have PGR divided by POR. And on the horizontal axis is time. So where does this diagram comes from? This diagram comes from one of Terence O'Dean's paper. Are investors reluctant to realize their loss? This is the same data Terence O'Dean has used for several of his paper. In fact, as I might have mentioned before, these type of micro level individual investor level data, there aren't that many of them to begin with. There are only a few of them. So this data set has been used many times by not only Terence O'Dean but also other people. In any case, So for a large group of small stock investors in the US, you calculate how often do they realize profit and how often do they realize losses, and you divide the two ratio with each other. That gives you this vertical axis. If people are doing things randomly, or if they're not timing the market, they're not particularly timing the market, and it just goes up and down, then what you expect is this ratio should be about 1, right? If they're doing things randomly, you buy a stock, you sometimes sell, you sometimes sell at a profit, you sometimes sell at a loss. But this would be particularly true if you believe the stock market is in a short run or random walk, right? Sometimes goes up, sometimes goes down, 50-50, so it'll be pretty much equal. Here, what you see is that in most of the time throughout a year, the ratio is actually positive, meaning that investors typically sell their holdings when their holdings are making a profit. This by itself, it's not surprising. Well, when you're investing, obviously you want to make money, right? So what's wrong with selling when you're making money? And in particular, if stock market generally trends up, which it does, it's not surprising that if you buy a stock at a point in time, wait some time, it would go up in value on average, and then you sell it, right? So it's the fact that the ratio is above 1 by itself is not actually surprising. People are not doing things randomly because they are investing to make money. That's okay. The interesting part is the slope. You see that there's a downward slope through time of the year, right? So somehow people are very likely to realize their profit, in January, and highly unlikely to realize their profit in December. That's the sort of surprise. That's the surprising part, because if people are simply investing, holding, and selling at a profit, you don't expect a negative slope, right? You sell when you make a profit, so it doesn't matter whether it's November, December, or January, right? If you're making a profit, you sell. But instead, what we're seeing is there's downward slope. So something is making people very unlikely to sell in January. Very likely to sell at a profit in January. And or since there's a ratio, it could be that people are highly unwilling to sell at a loss in January. In December, you see that the number is actually slightly below 1, which means that people are more willing to sell at a loss than selling at a gain. So this perhaps is the most surprising part. So what's happening here? Right. Okay. So gains are realized a lot more than losses. Okay. So what's happening here? So first, we should think about, in general, are people unwilling to sell at a loss? Do you think that's the case? Just think about people you know who invest. Yeah, generally yes, right? In Cantonese, we have a term which called people living on the boat, like Tangwu, right? So it's quite commonly known that people are unwilling to sell when their stocks are at a loss. So you do generally observe a significant more selling activities when stock price rise above the purchase price. That is quite clear. Why is that the case? Well, why is that the case? Clearly, no one likes to lose money, right? In some sense, the there are two ways you can explain why people are unwilling to sell at a loss. One is you believe the stock price is going to go back up. Right? That would be if you believe the stock price will go back up, the rational thing is not to sell, right? So if the stock price goes down, you believe it will go back up, then the rational thing is to wait until it goes back up. So that would be a belief in mean reversion. And we'll see whether that makes sense in a moment. So there could be a rational explanation, is that people are reluctant to sell because they believe it's going to go back up. If that would be rational if that actually happens and they believe that. But you could also have irrational explanations. People are doing that because they are unwilling to admit they are making loss. Right? They are unwilling to admit the defeat. Now, one piece of evidence that suggests that people are not doing this rationally is the common financial advice that you should set a stop. You should set a stop sell target. When the stock price goes down by a certain percentage point, like 10 to 15%, you should sell. That's a very common financial advice. The reason is, as we'll talk about later today, there is an effect called momentum. Stock price there is trend in stock price. When stock price goes up, it tends to keep going up on average, and when stock price goes down, it tends to keep going down for a while. So that's why it's called momentum. Given the existence of momentum, there is value. There's its value in selling when a stock has been losing value for a while. So rationally, it's generally a good idea to sell a losing stock. So we'll see evidence of that later on. But generally, it is a good idea that if a stock has been losing value for quite a bit, you actually should sell, instead of holding on it. In Hong Kong, there are many cases where people are willing to do that and lose a lot of money. One of the prime example being PCCW, the local telecommunication company. It was a private company acquire the local telecom company through high leverage, and then the stock price just went down from there. So people were really unwilling to admit that the price is never going to go back up to what it used to be. So it's quite clear. That's quite clear, as we'll see later on today. So there's also a question whether the unwillingness to sell actually affects your portfolio return. As I said, probably yes, but we will see evidence. We need to see evidence of that, because if there is mean reversion, then it would be a good idea to hold on. But we'll see evidence of that in a moment. But right now, we focus on this law, because so it's one thing that people are unwilling to sell at a loss and really willing to sell at a gain. It's another thing that there's a downward sloping relationship with time. For months, specifically month of a year. Right. So first, here's the evidence about whether it's a good idea, whether investors are good at timing their market, right? So, do investors actually have a good idea of how stocks perform after a particular transaction? So this is once again coming from the same data, and if you notice, for the economics majors, the previous paper was published in Journal of Finance, the top journal in finance. This paper was published in American Economic Review, the top journal in economics, and these are Terence O'Dean's PhD thesis, I believe. So he pretty much managed to get tenure right after graduation with this paper. And I think I'm not sure I've mentioned here, but I've mentioned in my undergraduate basic microeconomics class, Terence O'Dean managed to obtain this data by playing tennis with the boss of the brokerage. Right? It's very private, very sensitive data, right? It's individual level investment records. You need really good connections to get data like that. And with data like that, you can publish really well. Right? So in this paper, with the same data, What he's looking at is the subsequent return of stock or subsequent return of stocks sold by investors on average, and subsequent return of stocks sold by purchased by investors on average. So 0 obviously means the date of purchase and or selling, right? So now what you see is this. Basically, what this diagram wants to show you is after investors sell a particular stock price tends to go up. After investors buy a particular stock price tends to go down. That's the idea, which means they are really bad at timing market. Right. So that's what it wants to say. We'll see that once again. What's the reason for that? We'll be exploring models of stock market movement and investor strategy later on. But basically, you can imagine that if investors are sort of slow to react to news, then you could have something like that, right? So there's a stock that has been going up. The stock that is going up. If you heard about it in a very late stage, then it probably won't keep going up, right? So there's momentum is a short-term thing, something that has been going up to keep it. So we'll see it later in the second half of today's lecture. But you can see that either if they're getting information too slow, that the stock has already lost its momentum. So by the time you hear about it, it has been already going up for quite a bit of time. Later on, when we talk about analyst recommendations, when we talk about analyst reports on stocks, you see that reaction time is a crucial element in taking advantage of analyst report. So you pretty much have to act immediately upon the release of an analyst report. If you wait like 2 weeks, then analyst report is pretty much useless. So if you're a small investor and you heard about like hearsay that this stock is doing great in the past half a year or something, then it's not going to be really meaningful. That's a possibility. Another possibility is that they are momentum traders, which we'll talk about later. So if you simply trade on price movement, right? Just don't look at any fundamentals. Just look at if this stock has been going up, I would buy. This stock going down, I would sell. What would happen? Right? Then you might be catching up just noise, right? Just by random chance. Even if it's truly random rock, just by chance, sometimes stock price will be going up several days or even months in a row, right? That's the point of being random. Random means it could happen just by chance that it keeps going up or keeps going down. If investors are actually momentum traders, they just simply look at price movement in making the decision. It's possible that they misjudge a stock that happens to be doing well as a stock that actually does well. In that case, once again, they will be buying into something that is not really that valuable. So we will talk about that subsequently, but for now, it's quite clear that after they buy, stock price tends to go down, although it does go back up in longer term. And after they sell, stock price tends to go up afterwards. So they're not timing the market correctly on average. So what we also get out of that diagram is that it's not a good idea. It's not clear that you want to hold on to losing. The stocks that investors hold on to are actually stocks that gain in value, because what we see is that after they buy, stocks tend to go down in value. All right. So what is the disposition effect? The disposition effect is the observation that investors are much more reluctant to sell at a loss than sell at a gain. Right, that's the disposition effect. Okay. And there are several reasons behind. One is actually tax deduction. This is actually where the slope comes in. This is US data. When do you need to file for tax return in US? It's actually December. The cutoff is December. So in US, you can use losses in investment to offset gains in investment. Your capital gain tax depends on your net gain, right? So let's say you have some stocks that has been losing value, and you think that it's just going to keep losing. It's not going to go back up, like PCCW. It's not going to go back up. And you have some other stocks that has been gaining in value. Now, if you sell the stocks that has been gaining in value, you would have to pay tax on those gains, 15%. But if you don't want to pay tax, what could you do? Well, you could sell the losing stocks to realize the loss, to offset the gain. Right? If you really want to hold on to the losing stock, buy the losing stock back after buying tax. Right? So it's optimal thing. It's an optimal tax filing strategy to realize the loss to offset any gain you have. So that's why in December, near December, you'll see a lot more realization of losses. That's due to tax purposes. But that only explains December and November. It doesn't explain what happens in general when the ratio is very skewed towards selling the gain. So as I said, it could be a belief in mean reversion, but we don't have empirical evidence that there is that strong mean reversion to justify that. So another explanation would be prospect theory, that people are simply unwilling to realize loss because they hate losing money. They hate losing money. That's in fact this theory Terence O'Dean used in his paper. So now his paper is mostly empirical. It's not he's a applied person. He just do empirical analysis and not necessarily very technical one. So he does empirical analysis. So he simply explained there is this prospect theory, which at that point is pretty new, right? Not that it's pretty new stuff. He explained here that there's this diagram that we have seen. Right, that's literally what he has in his paper, and they say, look, there's this diagram. People are really happy. This is utility. People are really happy when they are gain. People are really unhappy when they're losing. So that's why they are willing to sell anything at a loss. So that's his explanation. A diagram with words, no math. Right. So that's his explanation. Okay. Here is diagram. Right. So the key and the reason why you want to sell at when you gain is, as Terence O'Dean observed, you have the utility function at gain is concave, right? It's concave. So if it's concave, then clearly people must be risk averse. And on the loss side is convex, so people is risk loving. And in Terence O'Dean's paper, that's his explanation. When a stock goes up in value, people become risk averse, so they sell. When the stock loses value, people become risk loving, so they hold on to the losing stock. Right. So that's his feeling. Oh, I have everything here actually. Right. So okay, so that's the theory. You can understand that it's very appealing on the first sight, because clearly, yeah, there's a concave function, there's a convex function. So, if you calculate the demand, for stock, relative. So this is where the purchase price is, and compared to what happens so this is, I think intercept is probably where the purchase price is, and this is the current price. So on the right hand side is current price higher than purchase price. On the left hand side is current price lower than purchase price. Right. So what do you see? What you see is the demand for a particular stock drops when the price goes up, by a bit. So people sell. Now it starts to go back up again. Now this is due to what we call what Baylor call house money effect. Is that because you're still holding some stocks, right? And your wealth is going up. So as you get richer, you start wanting to buy more stuff again if you have a CR or a utility, right? So you want to, as an investor, if you have if you have constant relative risk aversion, then you would want to invest more as you get richer. So this is the effect. You want to sell a bunch, but then if the stock price keeps going up, you become richer, then you want to buy more shares again as a ratio of your wealth. So it's because it's relative to your wealth. And if the price went down, then you want to hold it. In fact, in this particular paper, this is not Terence Lodine's paper. This is a different paper. It's a theoretical model. It actually suggested the investor want to buy more shares when the stock price goes down. See, it actually goes up very quickly. That should alert you to be suspicious, right? It doesn't sound very realistic that people would buy a lot more when share price are going down. I mean, if you're rational, you can argue that if you believe in mean reversion, then that's something you might do, but it doesn't seem very realistic. In particular, we're talking about a model where investors are not conforming to the traditional utility over absolute wealth. We're talking about they're looking at gain loss. So this behavior does not seem to be what we are observing. If this is the prediction of the prospect theory model, then it doesn't seem to be very realistic, because I don't think we actually see people gobbling up stocks when price tumbles. So, okay. So in any case, that's Terence Lodine's idea. He has this diagram. He explained intuitively that you have risk aversion in the gain side and the risk seekingness in the losing side. So that's why people are willing to sell when there's a gain and not willing to sell when there's a loss. That's his explanation. All right. Okay, so clearly I've already everything here. So let me erase that. All right. So that's the idea. Okay. Oh, all right. Describe everything already. So now that we've mentioned the simple idea, here's a more careful analysis of whether prospect theory actually explains disposition effect. So here's the problem. Loss aversion means that you are very risk averse initially. If I ask you, are you willing to take a bet in which there's a 50% chance you are going to gain $100, 50% chance you're going to lose $100. A lot of people would say no, right? And would say no. You could be risk averse, but in general, I think people are not very risk averse when you talk about money that's small amount, right? I could try to do $1, right? Gain $1, lose $1. That risk aversion should not come in, because $1 is nothing in your utility function, right? $1 is not going to affect your wealth. So your risk aversion over wealth should not affect your decision to decide whether you want to participate in this $1 bet. But a lot of people would turn down a $1 bet. You can say because they don't want to lose, right? Well, why I don't want to lose $1? I don't want to lose. So in any case, loss aversion would give you risk would be very risk aversion. the way you can see that by thinking about now this would be a traditional risk aversion utility would be concave like that, right? That's risk aversion by definition. And if you study microeconomics, you might have remembered the typical way to show that is that the average is actually worse than the equivalent amount with no risk, right? That's why people don't like fair bets. So you should have learned a diagram like that in basic microeconomics or intermediate, right? This is expectation of X, and then this is utility, or this is the expected utility of X, and this is the utility of expectation of X, right? Something like that. You should have seen something like that. You can superimpose this diagram and onto the gain loss utility, and you have something very similar. I think I have it here. Right, so it's the same idea. You consider 2 points. A stock has risk, and once again we simplify it to binary risk. Either it goes up or go down. So the stock price might go up, stock price might go down. I try to make it the gain is slightly higher than the loss. I think it's slightly further from the origin than the loss. So you have gain or loss. You join them with a line. The average is going to be on the line, and so the expected utility from buying the stock would be the vertical position corresponding to this hollow dot, right? So this is the expected utility from buying stocks, and it's negative for the same reason as you don't want to buy stocks when you're risk averse. You don't want to take risks when you're risk averse. Essentially, the loss aversion makes the whole curve concave. If I remove, so just do it here. If I remove the diminishing sensitivity, so I remove the curvature, right? If I remove the curvature, then what you have is essentially something like this, which is concave around the origin, right? The kink make the utility function concave. So this is actually concave. This is actually concave, right? This line is concave at this point. It's concave by the definition of concavity, right? Concavity means the average is going to be higher than the individual. So yeah, concavity is f of the function of the average is going to be higher than the average of the function of the individual points. So it's concave, just like this one, right? It's just that most of the time when we draw a concave function, it's curved because it's concave everywhere. But for the case of loss aversion, it's still concave around origin, right? It's just piecewise like that. It's concave. So because of the concavity here, investors are actually very reluctant to invest in stocks. Once again, it's the same idea as if I ask you to take a bet. Are you willing to take a bet of gaining $10,000 50% of the time and losing $10,000 50% of the time? Most people would say no. Now I can raise the stake by a little, right? Gaining $10,000 and $100 50% of the time and losing $10,000 50% of the time, people still say no. Right? But that's essentially what you are facing in the stock market. Right? There is some gain, but there is substantial risk involved. So you would expect people to be unwilling to buy stocks unless the return is very high, right? So I want to tell you something like oh, the stock. If you hold the stock for 1 year, you can expect 10,000. You can 1 year. Yeah, probably shorter than that. Let's say hold the stock for 6 months, right? 6 months. If you hold the stock for 6 months, there is a 50% chance it's going to make 10,000 to make $11,000, and there's still 50% chance you're going to lose $10,000, something like that. So that would be make it so people might start to be attracted by the 10%, but the 5% potential profit in 6 months, right? But you need pretty high return to attract people to buy stocks because stocks is quite volatile. Right, so what you need is higher return. And in this paper, Barbaros and Shaw, 2008, so it's also published in Journal of Finance, notice that this paper comes 10 years, exactly 10 years after Terence O'Dean's paper. It took 10 years for people to figure out what's wrong with Terence O'Dean's paper. No one actually paid any notice until 10 years later, right? So 10 years later, there's this another paper in Journal of Finance. What drives the disposition effect? And an analysis of a long-standing preference-based explanation, as the title suggests, long-standing. This is a theoretical paper. It just used simulations to examine what return you need to attract investors to buy to begin with. What you can see is that, now let's say this is your expected return, right? This is your expected return, expected annual return. And this is the number of trading periods within a year. Number of trading periods within a year. When the return is low, you actually don't get any trading. So what the dash means is that there is no purchase to begin with because the return is too low. So once again, 3% stock return is probably too low to attract an investor to invest in the stock market if you hold the amount of risk constant, right? Given the volatility in stock market, 3% is probably too low in return. Last time and the week before, we're saying that there's the equity premium puzzle. People are unwilling to buy stocks even though stock return is around 7% net of risk-free rate and something like 10 to 50% gross, right? So stock return in the actual market is very high because that's what it takes to attract people to invest in stocks, given the volatility. So 3% is way too low. As you can see, you would not buy at all. You would not buy. Okay, so that's okay. Let's look at cases where, let's just say, so stock market return could be higher, right? Actual stock market return is way closer to. So actual stock market return is closer to 10% than 3%. So let's look. So if it's high enough, people would buy. The problem is, if return is so high, why would they sell the stock afterwards? Why would they? So if return is very high, even if they're risk averse, they might still hold on to the stock afterwards, right? In general, when we model investors, we always model them as risk averse. That doesn't stop them from buying stocks. Risk aversion does not preclude holding of stocks. Rather, because stock return is high enough, you will hold on to stocks despite the risk. So once again, let's look at the diagram. Notice that I've moved this expected return higher. So this corresponds to a case where, let's say there's almost 90% chance the stock, or 80% chance the stock price is going to go up, 20% chance the stock price is going to go down, so it's not 50-50. That's why the average is skewed towards the upper side, right? Now, so let's just say so this time the investors will be willing to purchase because you notice that the vertical value Right? The vertical value indicates utility, and utility is higher than the utility of doing nothing. So the investor is going to purchase in this case. So let's say the investor purchased the stock, and since there's 80% chance the stock price is going to go up, let's see what happens when the stock price actually goes up. If the stock price actually goes up, then the investor's position would have gone from 0 to this positive amount, right? Because the stock is very likely to go up, so he's going to be here now. When he is here, we can plot the same distribution of stock price as before. There's some chance of losing money, some chance of gaining money. But notice that because the stock price has gone up already, even if the stock price go back down, he will at most be back to where he started from, right? And if the stock price keeps going up, he's going to earn even more. Once again, let's look at the average utility, the expected utility he's going to get. And, well, let's just say it's clearly not going to be lower, right? It's clearly not going to be lower. So the problem here we see is that once the return of stock is high enough for the investor to purchase, it's going to be high enough for him to hold. That's because the concaveness of the loss aversion is much stronger than the concavity of the concaveness, or the concavity of the loss aversion is much stronger than the concavity of the diminishing sensitivity here. Right? This is a very mild concavity. This here, the loss aversion part, is a very strong concavity. So if I can manage if the stock return is high enough to convince you, oh, do not be afraid of losing money because the return is usually very high, then it will be high enough to overcome any risk aversion you might have otherwise. If you're not afraid of losing money, then risk aversion is not really a problem. So that's the problem. Terence O'Dean's explanation actually doesn't work because if people are not willing, if stock return is so high that people are not afraid of losing money, why would they be risk averse? They're not going to be risk. Risk aversion is not very strong enough to deter them to buy stock, as you can see here. The mild concavity here is not enough to say, force to make the investors unwilling to continue investing. Right. So this is where these are the simulation values. The simulation values suggest that. So what this paper does is that basically it takes the standard prospect theory model with using parameters estimated from experiments and calculate with typical stock returns and volatility what would happen. And if stock return is so high that it can convince investors to invest, then they would never sell. If the volatility and the return is constant over time, right? If the property of the stock doesn't change, and you're willing to buy to begin with, then you're going to hold. It's a good investment, right? So that's the problem. So loss aversion means very risk averse initially. So stock return has to be quite high to induce investment. That means that you're very likely to make money. And when you make money, the curvature in the gain part is not enough to deter you from that attractive investment. So investors might invest even more after a gain than after a loss. Once again, that's called, you have the house money effect. So initially you're unwilling to buy stocks because you're afraid that you will lose money and you will lose your initial principal, right? You lose your money. But once you start making money, you have buffer because you start to think that, oh, at most I'm going to lose what I already gained. That makes you much more willing to invest further. Right? So that's called the house money effect, because it's called the house money effect by Richard Thaler, because that's the behavior you observe from gamblers. House money, because house as in casino, right? When a gambler wins in a casino, he is very willing to gamble away his game. Right? A very natural point for people to start gambling is when they loses all that they have gained. Right? It's quite common, right? When someone goes to a casino, they happen by chance to earn a lot, to earn a decent sum, and they keep playing. And since the average return in casino is negative, then the money they earn goes back down, and they usually stop when they loses everything that they have gained. Which is why casino rarely lose money that way. So that's why it's called house money effect. And it's the same in stock market. After the stock has gone up in value, people are much more willing to hold on to it. If you think about it rationally. Right. So how do you write down a model in which investors are very willing to sell at a gain and not willing to sell at a loss? Because turns out, if you have a traditional risk aversion utility over wealth, people would be holding stocks. If you have prospect theory utility, if people buy stocks, they will hold on to stocks. So you need some more complicated model. If you want to say that people are willing to sell at a loss, people are willing to sell at a gain, because most of the time it looks like people are willing to hold on to a gain under these models. So what you could do is you can allow people to have gain loss utility only over realized profit and not profit on paper. So as long as the stock is still in the account, it does not generate gain loss utility. You just use a standard utility. At the moment when stocks are sold, in additional to the standard utility over wealth, you add a component which is gain loss in nature. Right. So you could model this as saying, all right, when you make purchase decision, right? When you make purchase decision, this is what you're looking at. CRRA concave utility, right? This is purchase. The initial purchase decision is based on a standard concave utility over wealth. As long as you hold the stock, that's going to be the same, right? So initial purchase decision and holding would be a standard CRRA utility, and selling would result in a standard utility plus a gain loss component. That would give us what we want. In some sense, there's an adjustment, right? When you sell, if you happen to sell at a gain, that gives you a boost in utility, because you get a positive amount of utility from here. If you sell at a loss, you get a deduction in utility, because the gain loss utility will be negative. Right? You always have the standard utility over wealth. You always have that. But in addition to the standard utility over wealth, you have a gain loss utility. That depends on whether your stock has gone up or gone down in value. That would give you the incentive to sell at a gain, because you have this boost in utility. and you are unwilling to sell at a loss because there's this deduction in utility. So a gain would boost utility, a loss, selling a loss would lower utility. Right. So in some sense, it kind of feels like a cheating away, right? Because you have this you allow this additional component at the moment of transaction. So it's sort of an easy way out because you just with this simple combination you get what we think is happening. It turns out though that there is evidence in support of this theory that people might get an extra dose of utility at the moment of transaction. So it turns out, yeah, maybe it's actually a reasonable model of people's behavior. That they act normally they have this standard utility over wealth. At the moment of transaction, you have an extra boost in utility. It seems like that's actually something that people have. I will show evidence in a moment. So that's the idea. But theoretically, that's the idea. You have a standard utility over wealth. This gives you the standard behavior as in financial economics. If the return is high enough, you would buy because it's high enough to compensate for your risk aversion. At the moment of selling, if you sell at a gain, you get a boost in utility. If you sell at a loss, you get a deduction in your utility. So that gives you the extra incentive. So what evidence do we have that people might actually exhibit that behavior? So there are actually quite a few. First, experiments. Once again, undergraduates sitting in a classroom playing games. There's always this concern, how generalizable are results with all these undergrads playing games, right? But that's just a limitation you have to accept. These days experiments are conducted in many places, not just in like U.S. university with predominantly white students. So in terms of the population, we have diversified a bit because you have experiments that run in Europe, experiments that run in Asia, experiments that run in Africa. So at least the population has become more representative. But usually it's still university students because they are the group that is easier for researchers to contact. Some experiments would run on a representative sample of people, but that is rare because it's expensive to find a representative group of people. So this would be still students. Control experiment, students decide whether to buy or sell 6 assets for 14 periods. In this case, it's not an actual market. It's a people are playing against computers. The time series were pre-generated, right? So the whole movement were known to the researchers before the experiment begins. It's not random. It's randomly generated, but they just generated it once. Okay? It's not generated on site. So in experiment 1, the subjects were allowed to buy and sell as they wish against the predetermined time series, right? So you can buy and sell as much as you wish. Experiment 2 is more interesting, is that there is actually automatic forced selling after period for free. So there is no commission. So technically, it should make no difference because if there's no commission, you can always buy back what has been sold for you, right? If you think that it's rational to hold on to a certain amount and there's automatic selling every period for free, you can buy them back for free. So you would expect no difference. Do we actually expect to see a difference? So let's see. Once again, yes. This paper defines a disposition coefficient, which is the number of shares sold in gain minus the number of shares sold in losses divided by the overall shares sold. So it's essentially PGR minus PLR, right? Difference. Okay, how do you interpret? If the coefficient is about 1, what does that mean? How do you get a disposition coefficient about 1? You get about a coefficient about 1 when the number of shares sold in gain is very close to the overall number of shares sold, right? That's how you get 1. That means you're mostly selling at a gain. How do you get 0? 0 means that it's basically 50-50. That's why I cancel out. What about -1? That means -1 means you are mostly selling at a loss, which is kind of a weird behavior because you would not be making money. What do we see here? Right. So this is a cumulative distribution, right? This is cumulative distribution. So it has to add up to 1. A steeper slope. A steeper slope means more people are concentrated in that area, right? Because it's cumulative. So what this diagram shows you is that there is a whole bunch of people. You see a very steep slope here. That means there's a lot of people here. There's a lot of people here. How much? About this is about what, 75% up to 1, so that's about 25% of people, right? 25%. There's a lot of people who shows really strong tendency to just sell at a gain, right? So you can see that for these people, 80% of the transaction are sold at a gain, right? 80% are sold at a gain. The thing you want to remember is because these assets have predetermined probabilities, and the subjects were not told which stock is the better one, right? So if your initial purchase would probably have to be random. Your initial purchase would not be based on much information, and some people would bound if you're actually very rational in this market, you would observe what happens, and if you happen to hold stocks that have been going down, you want to sell them and switch to the stocks that have been going up. Here a lot of people just keep selling at a gain and never sell at a loss. Notice that the line we have just now is the experiment 2, where with automatic forced selling, and then the line here, the empty triangle line is the line where the subjects can do whatever they want with no forced selling. And here you actually see a lot less. You actually see sorry, the other way around. Okay, the solid triangle is the one where the solid triangle is the one where they can do whatever they want. The hollow triangle is the one where there is forced selling. Yeah, experiment 2. So with forced selling, you see a lot of people with no disposition effect. When you allow them to do whatever they want, you see some disposition effect. In general, what you want to look at is the fact that the two distributions are very different, right? The two distribution is very different, and so it clearly doesn't look like they are coming. They have the same behavior. People are a lot more willing to sell at a loss when you force them to sell. People are not willing to sell at a loss. People are not willing to sell at a loss unless and they only want to sell at a gain if you allow them to do whatever they want. Right. So since the only thing that differs the two experiments is whether people are forced to sell, and they are allowed to buy back the stocks for free. That is evidence that it's the moment of purchase and the moment of transaction that is the key here, right? if I force you to do the transaction, then the purchase decision would not be based on the same utility. So after I force you to sell, if I force you to sell, you don't want to buy it back. Right? If I force you to sell, you don't want to buy it back. If this is impossible, notice that this is impossible with utility, with the standard utility. With the standard utility over wealth, it's impossible for such behavior to occur, where if I allow you to hold, you decide to hold. But if I force you to sell, but allow you to buy it back for free, you decide not to buy it back. It's not possible with standard utility over wealth, because the standard utility over wealth would imply a certain amount of optimal investment, depending on the wealth. Standard utility says that, oh, this is the optimal investment, as we have derived in the very first class. Standard, if you see CRA, you want to invest a constant dollar amount. If you see RRA, you want to invest a constant percentage of your wealth. It always depends on your wealth. So it doesn't matter whether I force you to sell or not. If I force you to sell, you would buy it back, because that's the optimal holding. But here, that's not what we see. If you force people to sell, they are not going to buy it back. So that is something that you cannot explain that with standard order.
There's just no observation those students can make. They can't predict which stock.
They can predict from past trend, because they were told that there were 6 assets with a predetermined probability.
They're predetermined. They just don't know they can go up or down.
Right, they don't. Just like a real stock market. But you can figure out which stock is more likely to go up from past history, because this is not random walk. This is actually predetermined probability. Well, it's not 50-50, because some stocks have a higher chance of going up, some stocks have a lower chance of going up. By observing past record, you can make a decision, inform the decision on which stock is the most likely one to go up. Right. So
I just feel that the experiment tool is increase the denominator, the overall numbers of shares hold. So I don't know whether it has effect on the deposition coefficients.
So you mean that because they are being forced to sell, right?
Yeah.
So if they keep being forced to sell, and they buy it back, I should check. I think it should if they buy it back, it would cancel out.
Yeah. So it would tend to zero. At least it's more close to zero when doing experience 2. And experience 2, they can do whatever they want. Then it would tend to be at least far away from zero.
So whenever do they want, obviously, yeah, they're more likely to sell the gain, so it'll be close to 1.
So this is not fair to say that the experience 2 and experience 2 have different. They're just having a different standard deviation due to the experience.
Well, but this is the F. Yeah, but so here is just the number of shares sold minus the number of shares sold in a gain minus number of shares sold in a loss. If you buy it, so let's say if I force you to sell at a loss, right? If I force you to sell at a loss and you buy it back, right? Eventually you would have to sell it at the end. So it would increase the denominator and the numerator at the same time. So I think they should cancel out. Because this is a ratio, right? This is a ratio. So let's say I allow you to do anything you want, and you decide to sell. You decide just to sell it at the very end at a gain, right? So then would be overall shares sold will be 1. Just for example, like 1. Number of shares sold in gain would be 1, and the number of shares sold in losses would be 0. let's say somehow somewhere in the middle, I force you to sell at a loss, and you decide to buy it back. You decide to buy it back, and then just keep holding it, right? Pretend nothing happened. Then overall shares sold would overall shares sold would that would like a buy, right? Overall shares sold would be 2. Overall shares sold would be 2, and then number of shares sold would gain would be 1 minus 1, that would be close to 0. Because I force you to sell at if I force you to sell at a loss. So I would have to check if they actually cancel out if they buy it back. Because if you buy it back, then it would lower the shares. So I have to check. Maybe they somehow cancel out the transaction if you buy it back. But I have to check. Right. It's a good question. Right. This is an experiment that goes against the idea that prospect theory is behind disposition effect. Similar setup, very similar setup from a previous experiment, trading against hypothetical assets. Question at hand: is there a relationship between percentage gain and percentage loss realized? Now, if in the loss aversion story, notice that this is a loss aversion story, right? You have this utility function that reduces your utility if you sell at a loss. You have this utility function that very same utility function gives you a boost in utility when you sell at a gain, which means people who are willing to sell at a gain should be the same people who are unwilling to sell at a loss. They should be the same people because it's the same utility driving the effect. Everything comes from the prospect utility. Prospect utility makes you unwilling to sell at a loss, and it makes you really willing to sell at a gain. So it should be the same type of people. And this particular study says that, right, actually, even though we observe percentage gain realized bigger than percentage loss realized, as in previous studies, so each dot is a subject, right? Each dot is a subject. And what you're seeing here is the percentage gain realized on the vertical axis and percentage loss realized on the horizontal axis. Now, in one hand, you could have people who never trade, so it would be 0, 0, right? Or you could have people that trades a lot, right? Like 1, 1. If someone is on the top left quadrant, top left half of the diagram right here, that means that the percentage gain realized is higher than percentage loss realized, like because the 45-degree line is here. So this is, for example, 0.4 realized, 0.4 gain realized, 0.2 loss realized. And on the other hand, if you're on the bottom half of the diagram, then you would have like 0.4 loss realized, only 0.2 gain realized. So that's why these people are selling mostly at a gain. These people are selling mostly at a loss. You can kind of see that there are more dots in the gain part than the loss part. Right. The thing is, the people who are selling at a gain, are not the same as the people who are selling at a loss. Right. Right. So what will you expect? What will you expect is, according to prospect utility, this theory, right? Let's say you see someone who is never willing to realize a loss. So this is PRR 0, right? PRR 0. So he's never going to sell at a loss. If the explanation is prospect theory, then what you would expect is that the very same people who are unwilling to sell at a loss would be the same people who are very willing to sell at a gain. You are unwilling to sell at a loss because the prospect utility lowers your utility. You are very willing to sell at a gain because prospect utility increases your utility at the moment of transaction. Same utility brings you both effect. You can't just pick one. It brings you both effect. And right here, what we see is that it seems like people who are never willing to sell at a loss, they seems to range from people who are unwilling to sell at a gain to very willing to sell at a gain. There is no discernible pattern to say that the same people who are unwilling to sell at a loss are the people who are very willing to sell at a gain. There seems to be a whole distribution of people, which is not consistent with the gain-loss utility theory, gain-loss utility model. It looks like, because the point is supposed to be the boost in utility would make you willing to sell, and then you have this same idea, is that people who are really willing to sell at a gain does not seem to be particularly unwilling to sell at a loss. According to prospect theory, what you should see is that you should see a big cluster of people here. The people who are willing to sell at a gain should be unwilling to sell at a loss. But we don't see a cluster of people there either. Right? So it looks like there's no particular relationship between unwillingness to sell at a loss and willingness to sell at a gain. There seems to be no relationship. Prospect theory says there should be a relationship. Now I'm not sure if the paper. I think that the paper might. Since the paper, I don't think it does a very careful numeric calculation of how much people would be willing to sell. There does seems to be, if you look at this part, people who are really willing to sell. So the red circle here represent people who are very willing to sell at a gain. They always sell at a gain. In this case, there does seems to be no one in this particular group who always sell at a loss, right? So it's not clear whether exactly how much selling should be expected from the theory, since I don't think this paper actually provides a number. It's possible that. So it's still possible that it's compatible with the theory. It's just not as strong as it would expect. It's clearly not the case that people who are very willing to sell at a gain, this red circle, these people always sell at a gain. It's clearly not the case that they are never willing to sell at a loss. Right? It looks like some of them are willing to sell at a loss at 80% of the time. So it's not clear. It's clearly not the case that you would see people it's not clear. It's not clearly not the case that you would, when people always sell at a gain, they would never sell at a loss, because it looks like that's not the case. These people are willing to sell at a loss. And what do you make of these people? Once again, in experiments, you always have weird things happening. In this particular experiment, there are people who are unwilling to buy or unwilling to sell. So what are they doing there in the experiment? Right? You're not buying, you're not selling. Unwilling to sell at a gain or loss, I should say. Unwilling to sell at a gain or loss. So this is okay. You can collect. All right. And one thing you have to consider is that there is the tendency for people to do nothing, because from the previous slide you see that a lot of people just sit there, not trading very often. So they might just not. There's a tendency to do nothing, right? So tendency to do not. So if right. So besides actual the trading evidence is not very strong. The two papers are not published in very like now the previous papers, the Terence Odine's paper, Barbaras and Sean's paper, these are in Journal of Finance and American Economic Review. These are top journals. But the experimental papers are not in top journals, so the evidence is not very strong. Do we have something even better? So if gain loss utility is only realized profit, not profit on over realized profit, so what you will see, what you have essentially is a burst of utility at trade. Right? And you should expect the burst to be larger, right? The burst should be larger when the gain is large, right? The burst is larger when the gain is large, or when the loss is large, right? So the bigger the magnitude, the stronger the effect is. And one thing that you can look at is what's happening in people's head, literally. So you can use neuroimaging. So neuroeconomics is the area which use fMRI to monitor brain activity when subjects make decisions. This is cutting edge because it's not something you can easily do. You need an fMRI machine, right? So what does fMRI machine look at? Magnetic resonance imaging. It basically looks at the magnetic response of blood flow, right? Because blood cells is made of iron, so you can monitor the blood flow with the machine, and then you look at where the blood flows to when people make a decision. This is how neuroscience comes to understand which part of the brain does what. You ask people to lie flat in the machine, do all different types of tasks, and see which part of their brain lights up due to blood flow increase. This is an fMRI machine. Now it's enormous, right? It's enormous. It's also very expensive to operate. So very few places would actually have an fMRI machine for research, especially for non-neuroscience, outside of neuroscience directly. This study, I believe, took place in the study I'm going to describe took place in Caltech, where they have 4 fMRI machines for social science research. So Caltech, California Institute of Technology, is a very interesting school because it doesn't so it really combines all multidisciplinary research. So they don't have economics; they just have social sciences. So everyone study as social scientists, and you can use all sorts of technique inside. So this is one of them. So what you do is this: you have the subject lie inside the machine. I've actually done this experiment once when I was in school too. You lie inside the machine. Usually there's a screen that you see about here. There's a screen that you can see when you lie inside, and they give you a joystick, and you use the joystick to make decision. Right. In this particular case, they're going to look at trading behavior, and they're looking at 2 places. One is called VMPFC, which is an area right behind the nose bridge, and it signals the value of option, like choosing between different possibilities. Right. So what they're going to do is that they're going to ask them to trade. They're going to ask people to trade, right? And see what happens when at the moment they press the button to execute a transaction, hypothetical transaction, with reward, but still it's not actual stock market. It's just standard experiment where you get paid according to how much you earn in an experiment. Right. So VMPFC diagram is here. These are the VMPFC diagram. Each dot is a person. And the vertical axis is the proportional of gain realizes and the proportional of loss realizes. So vertical axis is how big the magnitude is, the red arrows. The horizontal axis is blood flow, right? Higher means more blood flow. So what you have here is that there is a positive relationship between blood flow in that particular region of the brain and the magnitude of the decision involved. When a lot of money is at stake, when you press the button, you're going to earn a lot of money. Then there's going to be a lot of blood flow. If you press the button, you're going to lose a lot of money. You're still going to have quite a bit of blood flow. You do notice that the standard deviation is very high, right? This is not something that is very consistent across people, right? But there is a positive relationship, just not. It's not very strong, particularly when for losses. Okay, there's another region that you can look at called VST, which is at the center of the brain, right here. And it's signal change in expected utility. This is quite interpretational, right? So, but it's supposed to signal the change in expected utility. And once again, you can look at what happens to that particular region when people trade. Now, so this time around, for this diagram, the vertical axis is blood flow. The vertical axis is blood flow, unlike the other two diagrams. The vertical axis is blood flow. The horizontal axis is seconds after decision making. Right? So the origin is the moment of the pressing the button, right? And what you see is that there's a huge flow of blood to that region at the moment of pressing button, and then it goes back, right? So once again, this is signal that you get a burst. So this is evidence that people do get a big burst of utility at the moment of decision. This paper it's not clear from what I typed here because there are quite a few co-authors in this paper. So this is once again published in Journal of Finance. Barbarous is one of the co-authors, I believe. So like the author, the scholar who proposed this framework where you get a standard utility plus a burst in utility when trading is also one of the co-authors in this paper, right? So this is evidence. This is evidence. This paper claims that this is evidence that this is the right model, where you get a burst in utility when you make decision. You don't just get a constant amount of utility. In some sense, I mean, it seems like it's common sense because I think everyone who have traded stocks would know that the moment you press the button is the moment that you're most anxious, right? Right. On the other hand, from an economist perspective, yeah, it is true that usually our model assumes that you would be you just have going to have the same amount of utility at every moment because your utility is over wealth. It's over your wealth, right? As long as your wealth does not change, your utility does not change. It seems like that's not the case because at the moment of execution, there's a huge flow of capital. Right.